Hey everyone, and if you are new here, welcome. Before we start, thank you. This channel is growing because of you. Every view, every comment, every subscribe, I do not take that for granted. Now, let's get into it. On March 2nd, 2026, gold futures breached $5,400 per ounce. That number had never appeared on a trading screen in the entire history of the commodity. 24 hours earlier, spot gold was trading at approximately $5,100. In a single session, the market added nearly $300 per ounce in value, driven by the largest flight to safety event recorded in modern financial history. The map of the world just shifted, and while most are looking at the headlines, the real story is happening inside your bank account. Welcome back. What happened in the gold market over the past 72 hours is not a normal price movement. It is what analysts are calling a regime change in the way global capital perceives risk. The traditional correlation between gold and treasury yields has disintegrated. In its place, a raw flight to quality has taken hold, positioning gold not as a hedge against inflation, but as the ultimate insurance policy against systemic instability. The invisible tax of inflation is moving faster than the news cycle. While the world watches geopolitical developments, the purchasing power of every dollar, euro, and pound is being repriced in real time against an asset that cannot be printed, frozen, or defaulted on. The cost of not understanding what just happened in the gold market is not theoretical. It is measurable. It is compounding, and it has already widened the gap between those who were positioned and those who were not. To understand the magnitude of what just occurred, one must first understand what gold was doing before this week. The surge did not begin in the last 72 hours. The foundation was built over years. Gold gained approximately 60% in 2025 alone, achieving over 50 all-time highs in a single calendar year. That was the strongest annual performance since 1979. The rally was driven by central bank buying, institutional fund flows, and a weakening dollar. By January 2026, gold had already risen 22% year to date. It was outperforming equities, bonds, and digital assets simultaneously. The structural bull market was already in full motion before any geopolitical catalyst. Central banks purchased over 1,000 tons of gold annually for 3 consecutive years from 2022 through 2024. In 2025, they added over 800 tons more. This was not speculative buying. It was strategic reserve diversification at an institutional scale. JP Morgan forecast in February 2026 that central banks would purchase approximately 800 tons in 2026. The bank described this as an ongoing, unexhausted trend of reserve diversification away from paper assets toward real assets. BlackRock's published analysis showed that the traditional 60-40 portfolio model was breaking down. Stock-bond correlations hit historic highs, meaning bonds were no longer providing the diversification benefit that justified their role in portfolios for decades. Gold was already being repositioned as the structural replacement for the role bonds once played. The largest asset manager in the world and the largest bank in America had both published this conclusion independently within days of each other. That was the foundation. Then the geopolitical catalyst arrived. Before examining what the catalyst triggered, it is essential to understand the fiscal backdrop. The gold market does not operate in isolation. It operates in direct response to the structural health of the world's reserve currency. United States federal debt now exceeds $38 trillion. It is growing at approximately $8 billion per day, or $92,000 every second. Interest payments alone have crossed $1 trillion annually for the first time in American history. The Congressional Budget Office projects that federal debt held by the public will reach 120% of GDP by 2036. Under more aggressive modeling, some analysts project 131% within the same time frame. Economists have identified a critical threshold where the interest rate on government debt exceeds the rate of economic growth. When this line is crossed, debt accumulation becomes self-reinforcing. The CBO's latest projections indicate this threshold will be crossed later this decade. Every Wall Street bank that raised its gold forecast in 2026 cited sovereign fiscal trajectory as a primary driver. JP Morgan's own CEO publicly warned about the unsustainability of the national debt. The same bank then raised its gold target to $6,300. When the CEO of the largest bank in America warns about sovereign debt and his own research division simultaneously raises its gold forecast by 25%, the connection is not coincidental. The institution is positioning clients for a deteriorating fiscal trajectory. The dollar's share of global foreign exchange reserves has fallen from 72% in 2000 to approximately 56% in mid-2025. That is the lowest level in 3 decades of IMF data. Gold's share has risen from 10% to over 17% in the same period. A World Gold Council survey found that 76% of central banks expect gold to form a larger share of reserves within 5 years. 95% expect their gold reserves to grow in the coming year. This is the consensus of institutions managing sovereign wealth. This is the fiscal and monetary context in which the geopolitical catalyst arrived. The structural demand was at record levels. The institutional repositioning was underway. The fire was already burning. When regional instability escalates to a level that disrupts global energy supply chains, the gold market responds not with incremental moves, but with vertical repricing. This is exactly what the historical record shows in every comparable episode. In 1973, during the oil embargo, gold rose over 60% within 12 months. In 1979, during the Iranian Revolution and the subsequent energy disruption, gold nearly tripled in a single year. In 1990, during the Gulf disruption, gold spiked immediately before stabilizing. In 2022, when the freezing of foreign central bank reserves sent a structural signal to every national treasury on Earth, gold began its current multi-year ascent. Each geopolitical stress event added momentum to a trend that was already accelerating. The pattern across 5 decades is consistent. Geopolitical instability does not create gold bull markets. It accelerates bull markets that are already underway. The structural demand must exist first. The geopolitical event acts as an accelerant, not an origin. This is precisely what happened on March 2, 2026. The structural demand was already at record levels. Central bank buying was elevated. Institutional allocations were rising. ETF inflows were accelerating. And then the accelerant arrived. Gold futures surged to $5,400. Spot gold jumped to approximately $5,300. The SPDR Gold Trust crossed $180 billion in assets under management for the first time in history. In a single month, gold-backed ETFs absorbed record inflows as investors moved capital out of equities, digital assets, and risk positions into physical bullion vehicles. The migration was institutional, not retail. The scale was unprecedented. Hedge funds that had increased gold exposure throughout 2025 saw their positioning validated. The 17 out of 25 top institutional holders that had increased gold allocations in the fourth quarter of 2025, including JP Morgan and BlackRock, were already positioned before the event. At the same time, hedge fund allocations to digital assets fell 28% in the fourth quarter of 2025. The rotation was explicit. When the geopolitical stress arrived, the capital that had already moved to gold was protected. The capital that remained in speculative assets was not. This divergence is the single most important data point for understanding what happened. Gold surged past 5,300. The leading digital asset fell below 65,000, down nearly 50% from its all-time high. The market distinguished clearly between a store of value and a speculative technology asset. The energy dimension of this event adds a layer that previous gold surges did not have. The disruption of a major global energy transit route threatens to push energy costs to levels not seen since the 1970s. When energy costs rise sharply, inflation expectations are forced upward regardless of central bank policy. Central banks face what analysts describe as a trapped position. Raising interest rates into a period of geopolitical instability risks triggering a deep economic contraction. Not raising them risks embedding higher inflation permanently. This dilemma is precisely what drives gold higher. When investors lose confidence in the ability of monetary policy to manage simultaneous pressures from rising energy costs and systemic instability, they move to the one asset that sits outside the policy framework entirely. Gold has no interest rate. It has no yield. It has no counterparty. It cannot default. It cannot be printed. It cannot be diluted by fiscal decisions made in any capital. In an environment where every paper asset carries embedded institutional risk, gold carries none. This is why JP Morgan's strategists describe the shift as investors willing to give up income to own something that is nobody's liability. That phrase, published weeks before the current events, now reads as prescient rather than theoretical. Given the current environment, analysts have outlined 3 potential trajectories for gold over the remainder of 2026. Each is grounded in published data and historical precedent. Scenario 1 is the stabilization outcome. Geopolitical tensions de-escalate. Energy transit routes reopen. Markets recalibrate. Gold gives back a portion of the crisis premium and settles in a range between $5,000 and $5,500. Central bank demand continues at elevated levels. Institutional allocations remain higher than pre-crisis levels because the structural arguments for gold were already established before the geopolitical event. The floor is permanently higher than it was 6 months ago. Scenario 2 is the sustained elevation outcome. Geopolitical instability persists for an extended period. Energy costs remain elevated. Inflation expectations rise. Central banks are unable to raise rates without triggering economic contraction. In this scenario, gold moves toward JP Morgan's revised target of $6,300 by year-end. Some analysts project higher if the energy disruption is prolonged. The crisis premium becomes embedded in the structural price rather than fading with the headline cycle. Scenario 3 is the acceleration outcome. Multiple simultaneous pressures converge. Energy supply disruptions combine with sovereign debt concerns, a weakening dollar, and accelerated de-dollarization to create a comprehensive repricing of the global monetary framework. In this scenario, the models break. JP Morgan's upside case of $8,000 to $8,500 becomes the relevant reference point. Gold enters what analysts call price discovery territory, where historical valuation frameworks no longer apply because the conditions have no modern precedent. Some major investment banks have suggested that if certain energy transit routes remain closed for an extended period, energy prices could reach levels that push gold towards $6,000 or higher within months, not quarters. The documented record of gold's behavior during geopolitical stress events spanning 5 decades reveals a pattern that has never once varied. The initial surge is sharp and rapid. A partial correction follows as the immediate fear premium fades. Then the structural repositioning begins. The structural repositioning is always larger and more sustained than the initial spike. It is driven not by fear, but by the institutional realization that the risk environment has permanently shifted. Portfolios are rebuilt around the new reality, not the old one. This pattern repeated after 1973, after 1979, after 1990, after 2001, after 2008, after 2020, and after 2022. In every case, the gold price after the structural repositioning was significantly higher than the gold price before the initial event. The question is never whether gold will be higher after a major geopolitical stress event. The question is how much higher and how long the repositioning takes. The historical range is 12 to 36 months for the full structural adjustment to complete. What makes the current moment unique is that the geopolitical accelerant arrived on top of the strongest structural gold market in over 4 decades. Central bank demand was already at multi-decade highs. Institutional allocations were already rising. The 60-40 model was already breaking down. The accelerant did not create the fire. The fire was already burning. The accelerant transformed it from a controlled burn into something much larger. Every major Wall Street bank has now raised its gold forecast. JP Morgan targets 6,300. Wells Fargo projects 6,100 to 6,300. UBS sees 6,200. Goldman Sachs targets 5,400. Deutsche Bank and Societe Generale both project 6,000. When every major competing institution independently raises its forecast to the same range within the same period, the underlying signal is not ambiguous. The data has converged. The institutions have converged. The only variable remaining is the speed of the repricing. The World Gold Council's 2026 Outlook, published before the current events, modeled a scenario where escalating geopolitical tensions could push gold 15 to 30% higher from levels at the time of publication. That scenario is now the baseline reality. The Federal Reserve faces its most complex policy environment in decades. The March meeting will be watched not for rate guidance, but for any signal about how the central bank intends to navigate the intersection of rising energy costs, inflation pressure, and systemic instability. If the Fed signals a pause or reversal of its rate path, gold will respond with another leg higher. If the Fed maintains its current course, the conflict between tight monetary policy and rising costs will deepen, further undermining confidence in paper assets. Either path is structurally positive for gold. The only question is the magnitude and the timeline. And the institutions managing trillions in sovereign and institutional wealth have already answered that question with their positioning. The relevant data is published quarterly by the Federal Reserve, the Congressional Budget Office, the World Gold Council, JP Morgan, BlackRock, and the International Monetary Fund. Every indicator referenced in this analysis comes from their public reports. The trajectory is directional. The flows are measurable. The institutional positioning is documented. The historical pattern is consistent across 5 decades. The information is not hidden. It is simply not widely understood. So the question that remains is this. If gold just recorded the largest single-session surge in modern history, on top of the strongest structural bull market in 4 decades, and every major institution on Earth is positioning for more, what does that signal to everyone who has not yet paid attention? The data is clear, the patterns are repeating, and the clock is ticking. Stay informed. There's a dimension of this shift that most financial analysis overlooks entirely. It is the psychological dimension. And it may be the most consequential factor of all. For 50 years, the dominant institutional assumption was that yield was the ultimate objective. Bonds paid interest, stocks paid dividends, gold paid nothing. Therefore, gold was inferior within the framework of modern portfolio theory. That framework functioned in a world where the yield was reliable and the currency backing it was structurally sound. Both conditions are now in question simultaneously. Bond yields are rising not because the economy is strong, they are rising because the government needs to borrow more. The yield is increasing because the risk is increasing. In this environment, the old logic inverts completely. Gold has no counterparty. It cannot default. It cannot be frozen in a foreign server. It cannot be printed by a central bank under fiscal pressure. It cannot be diluted by a legislative decision made in any capital on Earth. In an environment where every paper asset carries embedded institutional risk, gold carries none. The premium for owning something with zero counterparty risk is no longer theoretical. It is being priced into the market in real time. The expansion of the money supply between 2020 and 2022 created approximately 40% of all dollars in existence within 24 months. The purchasing power of every existing dollar was structurally diluted. Gold reflected that dilution with a lag that is now closing rapidly. Between January 2023 and March 2026, gold has risen approximately 180%. In the same period, major equity indices rose approximately 35%. Gold outperformed equities by a factor of 5. This is not an anomaly, it is a repricing of relative risk. The data point that ended the 60/40 model is this. During months when equities fell between 2022 and 2025, gold provided positive average returns while bonds provided negative ones. Gold is now empirically a more reliable portfolio hedge than government bonds. Both BlackRock and JP Morgan are building their client recommendations around this post-60/40 reality. The product launches, the ETF flows, the research notes, and the forecast revisions all point in the same direction. The Saudi Sovereign Wealth Fund was among those that increased gold exposure in the fourth quarter of 2025. When a sovereign wealth fund funded by energy revenues shifts allocation toward gold, it is a statement about the future purchasing power of the currency those revenues are denominated in. The rotation out of paper assets into tangible stores of value is not limited to Western institutions. Central banks in Poland, India, Brazil, China, and across Southeast Asia are all making the same directional move. The convergence is global and accelerating. The institutions moved first, they always move first. The 5-century record of monetary transitions confirms this pattern without a single exception. The only variable is how long the gap persists between institutional repositioning and public awareness. That gap is where purchasing power is either preserved or lost. Right now, according to every published metric, that gap is at its widest point in modern financial history. The question every person watching this must answer is simple. The largest financial institutions have repositioned, the central banks have repositioned, the sovereign wealth funds have repositioned. The data is published and the pattern is documented. The only variable left is individual awareness. That distance between what institutions know and what the general public understands is the precise mechanism through which purchasing power transfers during every monetary transition in recorded history.